Welcome. I'm going to start by talking about a few items that are from the OBA legislation and some other recent legislation in 2025. And the first item we'd like to go over is W-2 reporting for tips. One of the new provisions from OBA is an income tax deduction for tax years 2025 through 2028 for employees and individuals who receive qualified tips working in qualified occupations. They have identified that there are 8 categories of those qualified occupations, each with a designated 3-digit code. If you look in the booklet in pages 4 and 5, there is a list of those categories with the 3-digit code. And if you look on the IRS website, you can find a detailed list by specific job for all of the different jobs that come under the different categories. Those categories, though, are beverage and food service, entertainment and events, hospitality and guest services, home services, personal services, personal appearance and wellness, recreation and instruction, and transportation and delivery. So the first thing you have to determine is, are you in a qualified occupation? And then the second thing that you have to look at is what the definition of qualified tips is. So qualified tips must be paid in cash or an equivalent medium, such as check, credit card, debit card, or gift card. Qualified tips must be received from customers or through a mandatory or voluntary tip sharing arrangement, such as a tip pool. Qualified tips must be paid voluntarily by the customer. So that means that there are some tips that may not be qualified. For example, some restaurants impose a service charge automatically if you are a large party, and then they distribute that amount amongst the employees. If the charge is added with no option for the customer to disregard or modify it, those amounts distributed to workers are not considered qualified tips. And the other thing to keep in mind, of course, is that any amount received as a tip for illegal activity is not considered qualified tip. The IRS has decided that they are not making any changes to the 2025 W-2 format. So it's up to employers to provide that information so their employees can file their tax return and take the credit if needed. Brown Plus recommends that you use box 14 on the W-2 form, enter the 3-digit occupation code along with the total of the qualified tips. That means that if you have tips that are not qualified, you need to back them out of the amount that's included in box 7. The IRS will provide transition relief for tax year 2025 for taxpayers claiming the deduction, as well as for employers and payers subject to the new reporting requirements. And of course, if you need assistance with any of the calculations or with reporting, please reach out to Abbie or me or your tax advisor. The other new provision from OBA is the income tax deduction for tax years 2025 through 2028 for employees who receive qualified overtime. And again, we have to identify what is considered qualified overtime. So it is the premium portion of overtime, which is the amount that exceeds the employee's regular rate of pay. For example, the half portion of time and a half compensation. The other thing to consider is that qualified overtime, according to this ruling, is based on FLSA guidelines. So that means agricultural farm employees are exempt because they are exempt from FLSA. So they will not be able to take the tax deduction. The other consideration is that qualified overtime according to FLSA is only for hours worked over 40 in 1 week's time. So the calculation can't be made on a daily basis, on a pay period basis, and it doesn't include PTO or special incentives for working weekends or holidays. So you may need to make some calculations to the overtime to come up with the correct amount to report. Again, the IRS is not making any changes to the 2025 W-2 format, so it is up to employers to provide the correct information. Round Plus recommends that, first of all, you calculate the premium rate of overtime using the FLSA guidelines, and I'll go over that in the next screen. And then enter that amount in box 14 of W-2 with OVT as the descriptor. And again, the IRS is saying that they'll provide transition relief for tax year 2025 for taxpayers claiming the deduction and for employers and other payers subject to the reporting requirements. And we have an example here for the calculation. And in this particular calculation, this employee changed rate. He received a raise middle of the year. So at the beginning of the year, his regular hourly rate was $35 an hour. Overtime was $52.50 per hour. From January to September, he worked 62 hours of overtime. So the calculation for the premium that you would report is the overtime rate of $52.50 less $35 to get the premium hourly rate of $17.50 times the 62 hours comes to $1,085. October 1st, he received a raise, and the new hourly rate is $38 an hour, and overtime rate is $57. So during that October to December time, he worked 11.5 hours of overtime. So the calculation for the amount to report is his overtime rate of $57 less $38 to come up with $19 times the 11.5 hours comes to $218.50. So the total reportable amount is those two combined, $1,303.50. Again, if you need assistance with the calculations, with the reporting, please reach out to Abbie, me, or your tax advisor. And we have our first polling question. It's a true-false question. Okay. So the next topic we're going to discuss is related to the Secure 2.0 Act. This act is a significant piece of legislation that has brought about substantial changes to the retirement account rules in the United States in recent years. In September of this year, it was updated with some additional guidelines that we'd like to share with you. So for 2025, it provides for what they call a super catch-up limit for employees aged 60 to 63, and that is the age as of December 31st of the tax year. So in 2025, for 401k and 403b plans, the regular catch-up is $7,500. The super catch-up for those ages 60 to 63 is $11,250. And for simple 401k and simple IRA plans, the regular catch-up is $3,500, and the super catch-up for those ages 60 to 63 is $5,250. And those limits are printed in our booklet on page 52. We have the 2025 limits as well as projected 2024 deferral limits. The one change that came about from the September 2025 ruling is that beginning in 2026, high earners are required to use Roth contributions for catch-up and super catch-up contributions. High earners are identified as employees with Social Security wages over $145,000. 2026 has been designated as a transition year, so while it is in effect for 2026, the January 1st, 2027 will be the final date to comply with the guidelines. We recommend that you contact your retirement plan administrator to verify that your plan is set up to accommodate these new requirements. Another item that was changed or updated from the OBA is the FMLA income tax credit. This was originally introduced in tax year 2018. It was extended a few times, and then in this year, the OBA made this tax break permanent. It's an income tax credit for businesses who pay qualifying wages for family and medical leave per the FMLA guidelines. The minimum credit is 12.5% of wages paid if you're paying 50% of normal wages. And then the credit increases by 0.25% as you pay more than that 50%. And then the maximum credit is 25% of wages paid for up to 12 weeks per employee per year. There are several requirements. First being, you have to have a written policy in place that provides at least 2 weeks of annual paid family and medical leave to qualifying full-time employees, which can then be prorated for qualifying part-time employees. And your policy must state that qualifying employees on leave will be compensated at least 50% of their normal wages. A qualifying employee has maximum earnings of $96,000. That's for 2025, and it will be indexed. Through this year of 2025, employees had to be employed at least 1 year before they took the qualified leave. Starting in 2026, the employees only have to be employed for 6 months or more in order to take the tax credit. Another requirement, of course, is that these wages are paid for qualifying family and medical leave per the FMLA, which those guidelines include leave for the birth, adoption, or fostering of a child, care for a spouse, child, or parent with a serious health condition, an employee's serious health condition, and qualifying needs of a spouse, child, or parent who is a covered veteran or a member of the armed forces. Of course, because this is tied to FMLA, normal vacation leave, personal leave, and medical or sick leave, other than as specifically defined as this qualifying leave, do not qualify for the credit. And starting in 2026, OBA allows state and local mandated paid leave to count towards the eligibility of the tax credit. In this case, employers may only claim credit for paid leave that exceeds the state or local mandated amounts. reach out to your tax advisor if you think you may qualify for this tax credit. Now I'm going to turn it over to Abbie.
Thank you, Karen. We're going to start off with talking about sick pay. Preparing for this, definitely think about it as W-2 season is going to be upon us shortly. You will look to the coverage period to determine whether sick pay is considered taxable. So payments made during the first 6 months beginning after the month in which the sickness or disability occurred are considered taxable. Payments made after 6 months following disability, even if earned during the first 6-month period, are non-taxable. And a key note is if the employee returns to work even for 1 day, the coverage period will start over. When third parties pay the employee, they will typically remit the FICA Medicare taxes for the employee. The employer will then need to remit the employer share of FICA Medicare taxes and SUTA if applicable. It is important to clarify with your third party advisor who is filing the employee W-2 for the sick wages, as this will lead to how you will be reporting on your 941. You should receive statements, typically monthly, broken out by the employee, showing the payments and the amount of tax withheld for the employee taxes. This statement will give you guidance on what responsibility is on the employer. And again, if you ever have questions, you don't feel like it's cut and dry on those statements, I would reach out to your third party to verify that you are reporting things correctly. If the employer is reporting the sick pay on the W-2, it can be included in one W-2 with the regular pay, and you mark box 13 for the third party sick pay, or the employer can prepare 2 W-2s, one for the regular wages, and then a second one for reporting the sick pay. On the 941, the sick wages will be included in lines 2, 5A, and 5C, and then the tax adjustment will be made in line 8 as a negative tax amount if the third party is paying in the employee side of the FICA and Medicare taxes. And then the reverse is if the third party is reporting the sick wages on a W-2 for the employee, the sick wages will not be reported on the 941 in the wage columns. However, the employer will still need to report the FICA Medicare tax for the employee portion as a positive number in line 8. So again, consult with your reports to make sure that you are filing this correctly. And then additionally, Form 8922 needs to be filed by the employer if the third party is reporting the employee sick wages on a W-2 under the name and EIN of the agent or the insurer. This form is due at the end of February and is sent to the IRS, not to Social Security Administration. We are now reaching polling question number 2. Which of the following describes qualified overtime under HR 1? And then you can select one of the following. And the answer to that is number B, only the premium portion beyond normal pay rate. Again, you'll need to work out that calculation to come up with that amount. And now we'll move forward with Form W-4. There are no new updates to this W-4. If employees ask questions on how to complete the W-4, you can direct them to the IRS withholding calculator, which will help them complete the W-4 based off their personal information. Employees do not need to complete a new W-4 every year, even since there's been the new updates since 2020. If they have an old form, they can keep that. If you have a new employee who has not provided you a complete W-4, you can still process payroll for them, but you must withhold with single and zero adjustments, which is the maximum federal withholding, until you receive a completed W-4. If you ever suspect a W-4 is false or invalid, it should be rejected and a new one should be requested from that employee. And then again, you would default to withholding at the information on a previous W-4 if they are making a change, or it must be at single with zero adjustments. Employers are not required to verify accuracy of a W-4 unless it's clearly invalid or you have a suspicion it's invalid. An employee may be fined $500 for providing false W-4 information. And then some examples of an invalid W-4 would be if anything is incomplete or missing, the employee did not sign this, any of the official language on the form has been altered, or any additional language has been added. And then the only caveat to that is if the word exempt is added to the W-4, that does not make it invalid. And then we will flip over to I-9s. The most current form is the one with the expiration date of May 30th of 2027. And this was released in August of 2023, so you're probably using the most current form. The major modifications for when that form was updated are alien is now replaced with non-citizen. It's now formatted for completion in tablets and mobile phones in Adobe. There is a reduction in section 1 and 2 to now fit all on one page. And employers can now enroll in E-Verify and remotely examine employees' I-9 documents. And then some key things to take away with the I-9s is maintain all employee I-9s separately from your employee personnel files. That way, in the event of an audit, you can provide just the information that the auditor needs, which would just be those I-9s. Employers can choose to scan original scanned forms to retain them electronically. Once the I-9 forms are securely stored in an electronic format, the original copies may be destroyed. If you discover an I-9 was never completed for an employee you already have that employee completed immediately, and you do not want to backdate the form and state the actual date that the employee started in section 2, and then attach a signed and dated explanation for the corrective action taken to include with your documentation. And then non-payroll income tax withholding. This form 945 reports federal withholding withheld on non-payroll payments. These payments are typically for retirement plan distributions and backup withholding for 1099 information returns. Compensation paid to H-2A visa holders, also known as foreign agricultural workers, are typically paid on Form W-2 and then reporting the tax on Form 943. However, if an A2A visa worker did not provide you with a taxpayer identification number, the employee is subject to backup withholding, and wages should be reported on Form 1099 miscellaneous. Federal withholding is now required to be remitted electronically, and it can be paid via EFTPS, just like you remit your federal tax deposits for Forms 941 and 940. Just select 945 in EFTPS and the appropriate tax year. You can avoid an improper payment penalty if the tax is less than $2,500, just like on the 941. You are then able to send in a check for the full amount with the coupon voucher and the return if you mail that in on time for the due date. For 2025, it started in March of this year. The IRS now offers direct deposit for tax refunds. So in the event that you made an error and overpaid, you can request this service. You will just need to complete your bank account information on lines 6C through 6E. You will also still search for, so you'll also still select for the, have the option to select the overpayment to be applied to the following year if you don't want to get that refund immediately. For years that you do not have federal income tax liability, you do not need to file a 0945. And that 945 is an annual return, just like the 940, and it's due February 2nd of 2026. If you have paid in full all of your tax deposits throughout the year and remitted them timely, you get granted until February 10th of 2026 to file that return. And jumping over to the deposit rules for non-payroll income tax withholding, monthly depositors of $50,000 or less are for that look back period. Semi-weekly depositors are greater than $50,000 in your look back period. And then the 1 day rule applies just like with other payroll taxes, that if you hit $100,000 or more, then you become a semi-weekly filer for the remainder of the year and the following year. And that is, like I said, the 1 day deposit rule. So you need to remit that quickly. The look back period is determined by using the second calendar year preceding the current calendar year. So for example, 2026's look back period will be 2024. And the penalties for untimely payments are very similar to payroll tax deposit rules. And PA requires withholding at 8.07% on non-wage PA source income payments made to non-residents for payments that are $5,000 or more for the calendar year. If you aren't 100% sure, the state does recommend that you just go ahead and pay that in, even if you don't meet that threshold. And then you can register with the PA 100 via MyPath if you need to file 1099s of 10 or more electronically and you do not have a PA withholding account ID. Now we're going to do polling question number 3. Which age range qualifies for the new super catch-up contributions under the Secure 2.0 Act? And the answer to the super catch-up is B, 60 to 63 age range. We are now going to switch over to PA and discuss Pennsylvania. We're not going to shock you as much as we did with federal. There's pretty much same as usual for PA this year. The only change for 2026 is the increased wages for Social Security. The new Social Security threshold will be $184,500. In 2025, it was $176,100. So that results in an increased tax of $520.80 for the employee and additional $520.80 for the employer. And that wage increase from 2025 to 2026 is $8,400. And the wage increase from 2024 to 2025 was $7,500. So you can really see that hiking up each year. PA does not have a credit reduction due with the 2025 940 return. California, Connecticut, and New York are subject to credit reductions of 0.9% for 2025, and these are the same states that had the credit reduction in 2024. PA new hire reporting. Employers need to report newly hired and rehired workers to the state for them to cross-match open child support cases, locate non-custodial parents who change jobs frequently, and reduce fraudulent overpayments in state benefit programs such as unemployment and workers' compensation. Temporary employees are required to be reported, but is the responsibility of the temp agency. PA employers would report all employees who reside or work in PA to the PA new hire program. New hires are reported through the PA career link. You will see that website on the slide. This can be reported manually if there are 10 or less new hires to report, and an account does not need to be set up to report this way. You can just log in, put your employer information, and start registering those new hires. If there are 10 or more, you can upload an Excel file. This template file you can download from their website. It's pretty user-friendly. You also have the option to upload via a secure file transfer, but in this case, you are required to request an SFTP credential. And there are very helpful videos, they're very brief, on their site to walk you through the necessary steps for each of those possibilities on how to report. Electronic funds transfer for Pennsylvania. All state tax payments of $1,000 or more need to be paid electronically and can be remitted through MyPath. Approved payment methods are ACH debit, ACH credit, certified or cashier's checks that are hand delivered, or credit and debit cards. There is a 3% penalty assessed with a maximum of $500 for non-compliance. The mandatory electronic payment threshold for unemployment is if the total threshold owed equals or exceeds $5,000 per payment period. It's also important to note that once this threshold is met, all subsequent payments are also required to be remitted electronically. Failure to comply with that requirement would result in a 10% penalty base in the face value of the payment, with a maximum of $500 as well. And payments for unemployment can be made through the UCMS website. And then skipping now to PA unclaimed property. Writing dormant accounts off into income does not negate the obligation to report and deliver unclaimed property. That's creative accounting. There are no de minimis amounts for reporting thresholds either. The holder reporting record system keeping was updated in June of 2021. So if you previously had an account set up and have not remitted anything since 21, you will need to register for a new account login under the new system. Payroll and commissions are deemed abandoned after 2 years. So any uncashed paychecks from January 1st to December 31st of 2023 should be reported as the dormancy period year 2025, and the due date to report those returns this year is April 15th of 2026. You can also request early remittance, but the property still must be at least 1 year old to be approved. If you have more than 10 items to report, you are required to file these electronically. Reporting is again due annually on April 15th, and electronically reporting can happen through the state's website for free if you have under 99 items to report. Reporting is prepared using forms AP1 and AP2. AP1 includes all of the holders' information, so that would be your employer information. That's pretty easy to complete. And then AP2 is the reporting detail list of all the unclaimed property. And then just a word of wisdom, if you have a current employee that has old paychecks that aren't cashed, it's the best practice to just ask the employee to cash those paychecks if they still have them. You can also issue them a new check, and instead of reporting it to unclaimed property if they have misplaced that. You can even do this with employees that if you have their contact information and they are no longer working for you, to get those cleaned up. And now we will hand it over to Karen from Maryland.
As Abbie said, most of the changes this year were on the federal side, so I won't have as many things Maryland-wise to go over. So we have another polling question. If a third party handles sick pay and tax filing, the employer doesn't report those wages on payroll filings. It's a true-false question. And the answer is false. The employer must still ensure taxes are withheld and reported correctly. So moving on to Maryland, we have a slide that looks very similar to Pennsylvania. And as Abbie said, Social Security wage limit has gone up. Otherwise, there are no changes in the Maryland unemployment wage limit or any of the other taxes. For Maryland unemployment, you still use the Beacon website for filing and making payments. The returns must be submitted on the Beacon website. The payments can be done either via an EFT payment. I think they give an option for debit, ACH debit or credit, or you can print a paper voucher and mail in a paper check. However, we would recommend that you use the debit option so that they get the payment and they post it properly. We have worked with some clients that have gone the paper check route and it hasn't always turned out well. I will also say the new rates for unemployment for Maryland will come out mid-January, and the quickest way to see what your new rate, unemployment rate will be is to log on to that Beacon website. There's a place on there where you can check what your rate is. They do send out mailings, but the Beacon website is the quickest way to get that information. And of course, Maryland has a state tax, but then they also have various local taxes depending on where employees live. The 2025 rates are in our booklet. The 2026 rates, though, should be out sometime in December, and we have the website listed there. They've been very steady in the past few years, so we don't really anticipate any changes or many changes. I will, however, note that Anne Arundel and Frederick counties have what they call sliding rates, so the rate depends on the total gross wages. And like Pennsylvania, Maryland has EFT options and websites to file returns for the withholding and for sales tax. The B-file system was retired in January of 2024 and was replaced with the Maryland Tax Connect. The Maryland Tax Connect is used specifically for the withholding and the sales and use tax, also for filing the W-2s at year end for employers. It's also where you apply for new business registrations and licenses. In the future, the website will be used for additional taxes. I do want to make note that one of the helpful things on the Maryland Tax Connect website is that there's an option to schedule a callback appointment. So if you have any issues with the Maryland Tax Connect website or with your withholding or sales tax account and you want to talk with someone, you can schedule a callback. You just give them, you schedule a time and give them your phone number and name, and they will call you back. And we have found that to be very helpful. And just as in Pennsylvania, there is a requirement in Maryland to report new hires and rehires within 20 days of the hiring date. And that can be done either on the website, marylandnewhire.com, or you can fax in a form, and we have a copy of the form on page 221 in our booklet. The Maryland Saves program was introduced in September of 2022, and there's not really anything new with it, but I do want to go over it. It is an employee savings only. It is designed to be a retirement plan for employers who don't have a separate 401k, 403b, or simple IRA for their employees. The deductions are taken out of employee checks post-tax and qualify as a Roth IRA. And as I said, there's no employer match for it, and there is no cost to the employer for administration other than the time it takes to set things up and to submit the payments. There is an exemption from the Maryland Saves program. If you as an employer have a retirement plan already, a separate retirement plan, you can certify under the marylandsaves.org website and receive a waiver of your Maryland personal property annual filing fee of $300. And I just see on that screen, it says December 1st. It's actually, the deadline is December 31st for that recertification. We need to do that every year. And then when you file your Maryland personal property tax return for 2026, you won't have to pay that fee. There are two websites for the Maryland Saves program. One is the marylandsaves.com, which provides the program information and the guidelines. And then the marylandsaves.org is where you go to do the registration and the exemption certification each year if you have a separate retirement plan. Next polling question is, employers must maintain Form I-9 records, and then you choose which one. And the answer is letter C, in a separate file to avoid privacy issues. So the Maryland Paid Family and Medical Leave was first introduced several years ago, and it was set to start on July 1st of this year. But in April of this year, they announced that they were delaying the program until 2027, 2028. None of the guidelines of the plan from their initial draft have changed. It's just the timing of it. So January 1st, 2027, deductions, contributions begin. And then the first quarter of 2027 is when the first returns and contributions need to be paid in. And then the benefits will become available to Maryland employees January 3rd, 2028. The idea of this family and medical leave program is following about 14 other states that have a similar program to provide for when people need to be off for the FLSA type guidelines. There is an option for employers to choose and seek approval for a private plan. Taxable wage definition is the same as Maryland unemployment, and it's good to note that there are no employer exemptions. So even if you're a nonprofit or religious organization, you still are required to comply. And again, as I mentioned, the contribution guidelines are the same as what we went over last year. It's 0.9% of covered wages divided between the employer-employee. There is an exception for employers who have 14 or fewer employees. It makes the employer contribution optional, but they still are required to deduct the 0.45% from employees' paychecks. And then there's a self-employed opt-in of 0.9%. The benefits, as I said, they will start January 3rd, 2028, and the qualifying events follow FMLA guideline. And there is a website there that you can check out. And they do have an option there where you can sign up for email updates, which is very helpful, especially when they were deciding this year if they were going to delay the program. Maryland unclaimed property, unclaimed payroll checks, it has not changed. It's still after 3 years, uncashed checks, whether they be payroll or vendor, are considered abandoned property. And you have to send notice to the recipient before you turn the funds over to Maryland. And then if there's no response or if it comes back in the mail, then you have to report and transmit those funds to the state. As in Pennsylvania, if it's 10 or more items, you have to submit everything online. If it's under that 10, you have the option to do paper. However, they are strongly recommending the online submittal. And their website does have a good reporting manual. That is a new updated manual, so you might find that helpful and find more information there. And the last thing that we're going to talk about related to Maryland is the new 3% tech tax, which went into effect July 1st of this year. It is a sales tax directly on certain technology, data, and IT services, and it is distinct from the Maryland's regular 6% sales tax. Example of services included, I have a number of them listed on here: cloud computing, cloud storage, hosting, backup, web hosting, lots of options there that it could be included in this 3% tax. They also have identified certain NAICS codes that you would use. So if you're under those, you might need to be registering, signing up, and collecting those taxes. So the compliance for this is that vendors in or out of state with Maryland customers must register, collect, and remit that 3% tax when applicable using the Maryland Tax Connect website. Out-of-state providers need to identify if they have economic nexus, which is typically more than $100,000 in Maryland sales or over 200 transactions. I would suggest if you are in that state, I would reach out to your tax advisor to verify whether or not you have nexus and need to register and start collecting the tax. It also to note, sellers must carefully classify their service to decide if the 3% tax applies. And on the invoices, they need to be careful not to bundle services, because if it's not properly itemized, they might need to charge 3% sales tax on a full bundle. There are some exemptions as other sales tax. If you're selling to nonprofits or government entities, you need to get a valid exemption certificate. There's also certain cyber security businesses, and there is designated emerging technology development areas that may qualify for exemptions. Another thing to note is multiple use of certificate. So if the service is used both inside and outside Maryland, the purchaser can submit an MPU certificate to the seller, which allows the tax to be apportioned. And then in those cases, typically the seller does not charge the sales tax, but then the purchaser pays the use tax on their return. And it's good to note that you have to get a separate MPU certificate for each transaction, and those can be obtained from the comptroller's office. And the final thing I wanted to mention is resale certificates. So if an individual or a company is providing taxable services to a buyer who will be reselling those services to another customer, the buyer of those services should provide a Maryland resale certificate to the subcontractor to indicate that sales tax shouldn't be charged. That's so that the end user is the one who pays the sales tax. And those resale certificates can be produced on the Maryland Tax Connect website by anyone with a valid CRN number. And I think we're okay. Polling question number 6. Maryland's new 3% sales tax on IT services effective July 1st, 2025 applies to which of the following? And the answer is C, cloud computing, data processing, and IT consulting services. And I think we have time for questions and answers. Are there any questions?
We do have some questions. The first question is, in the first section that you went over regarding W-2 reporting and overtime, is this something that most payroll companies handle for their clients, such as ADP or Paychex?
It is our understanding that they should be reporting that. How they choose to report it, we have not received definitive advice, although most of the people we've talked to have talked about box 14 because that is a box that you can enter things that don't require the IRS to have a format on the W-2. Box 12 will be used in future years.
Next question is, for the Secure 2.0 Act, is this a requirement for employers to provide this option of catch-up and super catch-up for simple IRAs?
I believe that is optional. So because you have to request it from your retirement plan. I would actually have to look that up unless someone else knows the answer to that. I'm fairly sure though in my reading that it was optional for the super catch up. So I don't know if you have an email address or something for someone and I can look that up and we'll get an answer for that for sure.
And then the last question that I'm seeing right now is, that it looks like it's just California and the Virgin Islands for the FUTA tax reduction, not Connecticut or New York.
Okay, that might have changed since I've done my research on this. They originally were on the list. I can email and clarify that as well.
Good afternoon, everyone. My name is Joe Cawley. I'm a tax principal here at Brown Plus. I get to take the second leg of the presentation here, so I have a couple of topics that I'll speak about. We're going to talk about COBRA for the beginning of the presentation, then we'll get into fringe benefits and the taxation of those benefits, and then I'll conclude with taking a look at the 2025 W-2 based on some of the concepts we'll talk about during this part of the presentation. So on the COBRA, this is continuation coverage under COBRA. We bring this topic to you, if I could get it to stay on the slide I'm looking for. Okay, here we go. So with COBRA continuation coverage, a lot of employers and probably most of the attendees in the seminar will have employer-provided healthcare coverage. So if you are in that group with employer-provided coverage, you could be subject to the COBRA continuation coverage provisions. So what happens here is that under COBRA, you as the employer must provide a written notice to each covered employee and spouse and dependents of their rights to continuation coverage upon certain events as they occur throughout the year. And what are those events? They are a termination of the employee or a reduction in hours where they go from full-time to part-time, divorce or legal separation, dependent child ceases to be a dependent, the death of the covered employee, or the covered employee becomes eligible for Medicare. So based on those events that could occur, you as the employer may know some of them, you may not know all of them. So the employer must notify the plan administrator of a death of the employee, a termination or reduction of hours, or when the employee becomes eligible for Medicare or a bankruptcy of the company. The covered employee is responsible to notify the plan administrator if there is a divorce or a separation or when a dependent child ceases to be a dependent. So at that point, once there's a notification to the plan administrator, a notice will go out to the former participant of their rights to continuation coverage. Again, with respect to the COBRA, it is for employer-provided health care. It is mandatory for employers with more than 20 employees. If you have fewer than 20 employees, you would not be subject to COBRA. However, you could be subject to mini COBRA. Government plans and church plans are typically exempt from COBRA as well. There are penalties for failure to comply with the continuation coverage rules. The IRS can penalize plan providers who do not provide these notices. They can assess an excise tax of $100 per day, maximum of $200 for each qualified beneficiary that does not receive notification. That penalty can be assessed for a period of up to 6 months. So it can become an onerous excise tax if that is assessed on you. The other monetary penalty would be that the employer would have to correct the failure and put the qualified beneficiary back to in the same place they would have been had you provided the continuation coverage. So with respect to COBRA, you want to make sure that you are in compliance with this. Again, the penalties can be significant and they can be, they could add up to a large dollar amount. Okay, now we're going to move into fringe benefits. And if you're following along in the booklet, I'm on page 55 and 56 starts this information. So fringe benefits, what are they? Fringe benefits is a form of pay for the performance of services that's given by the employer to the employee in the form of a fringe benefit. So what you have to keep in mind here is that fringe benefits generally are taxable as compensation unless the employer can find an exclusion in the tax code to exempt that fringe benefit from taxation. If we do have a taxable fringe benefit, it's subject to federal income tax, subject to Social Security and Medicare. So you would have to include withholding on that fringe benefit. You as the employer, if you do have taxable fringe benefits, you do have some discretion as to when you're going to include that in compensation. You can do it weekly, monthly, quarterly, but at a minimum, you have to do it annually. So although you have that choice, you do have to do it annually if you opt not to do it on a more frequent basis throughout the year. If you're not including the fringe benefit in with regular wages in a pay period that you're going to include it, if you're going to do it separately, there's a mandatory 22% federal withholding rate on that benefit. In addition to that, you would be subject to payroll taxes and depositing those payroll taxes in the period that you include it. So where do we find exclusions for these fringe benefits that we could be providing to our employees? Code Section 132 provides exclusions in the form of, if it's a de minimis benefit, it would be an exclusion. If it's an employee discount being provided by the employer, it can be excluded. No additional cost benefits get excluded. That's if we're allowing employees to use some service provided by the company that comes at no additional cost by allowing them to do it. Working condition fringe benefits are also excluded. There are other code sections that do exclude a lot of the benefits that we provide to our employees. Accident and health benefits for insurance is excluded. Now that comes with an exception for 2% or greater shareholder employees of an S Corp. And we'll talk about that a little bit later. If you do have achievement awards, those can be excluded. Dependent care assistance, group term life insurance, at least a portion of it can be excluded. But there is an exception again there to 2% shareholder employees, and educational assistance benefits under an educational assistance program can be excluded as well. Polling question for you. All fringe benefits are taxable compensation to the employee. And this is a true or false question. And the answer to that, if you're following along here, is false. Again, generally, fringe benefits are taxable, but there are fringe benefits that can be excluded under various code sections of the Internal Revenue Code. From fringe benefits, we move on to, or at least setting up the concept of taxing fringe benefits. We're going to move into business expense reimbursements. So the key to business expense reimbursement plans is having what's referred to as an accountable plan. So you as the employer have an accountable plan if you require your employees to submit documentation, when they are getting reimbursed for various business expenses that they may incur on behalf of the company. Under an accountable plan, and it doesn't have to be in writing, but an accountable plan requires that there's a business connection for the expense. It's subject to substantiation. Again, whatever dollar amount is being requested, you are looking for receipts and other documentation as to the amount spent by the individual requesting the reimbursement. If you gave them an advance on certain expenses, travel expenses, they're going to return the excess amount that has not been substantiated. If you are an employer that's reimbursing on IRS per diem or mileage rates, that amount is deemed substantiated. They would have to provide the business connection and the amount of miles or the place of travel if it's for an overnight stay in a hotel. So having an accountable plan is a win-win proposition for employers. You as the employer can deduct the expenses and the employee would not have taxable income. So they'd have a non-taxable fringe benefit. Again, on the slide we're looking at here, which is in your booklet as well, this is what you need to have an accountable plan. And if you are not reimbursing under an accountable plan, by default, you're in a non-accountable plan. A non-accountable plan is taxable, and it's taxable at the time you make the disbursement to the employee. Then the next page in the booklet is what you need in terms of documentation in an accountable plan. So again, you're looking for amount, time, place, business purpose, business relationship. Again, I'd encourage you to copy these 2 pages out of the book to hand them out to your employees as to this is what we're looking for if we are reimbursing business expenses. There's also limitations on certain business expense deductions. Business meals have that 50% deduction limitation, and that began January 1 of 23. Entertainment is non-deductible. Travel expenses for dependents is non-deductible. And then moving expenses can be limited depending on the circumstances, and employee achievement awards, if your plan is providing benefits greater than the IRS allowances, that can create some business deduction limitations. Group term life insurance, we talked about some of the taxable fringe benefits. Group term life can be one of those taxable fringe benefits, and a lot of employers have group term plans. For the value of the first $50,000 of group term life insurance, that amount is a tax-free fringe benefits for most of your employees. That will change if you're an S corporation with 2% or greater shareholder employees. The value in excess of $50,000, so if you as an employer are providing group term life insurance and the participant can purchase an amount of insurance in excess of $50,000, the amount in excess of that $50,000 is a taxable fringe benefit. And if you have that type of plan, you will need to be calculating a fringe benefit. So for group term life insurance, that fringe benefit is determined using the table from Section 79 called the Uniform Premium Table. It's based on the age of the participant and the dollar amount of coverage that would be in excess of the first 50,000. So in our example here on the slide, we have an employee that's age 55 receiving $100,000 of group term. And in our example, that employee is paying $10.50 monthly towards that coverage. What you have to keep in mind with this table, it is a per month benefit calculator. So it's only calculating 1 month of coverage. You would have to multiply that number by 12 to get to the annual amount. So in our example, we picked up a taxable benefit at 43 cents per $1,000 of coverage over 50,000. We would then subtract the $10.50 that the employee paid, which leaves 11 per month. If the employee is not paying for any of that coverage, then it would just be the amount of 43 cents times the excess per month. In our example here, that's $132 taxable fringe benefit. So we would have, in this case, the need to calculate a taxable fringe benefit before the end of the year. Another area where we see taxable fringe benefits with a lot of companies is in company provided vehicles. So again, a lot of times when an employer is providing vehicles, there could be a taxable personal use amount for that fringe benefit. The only exceptions to that would be if it was a working condition fringe benefit. And what that would mean is that the employee is only allowed to drive it for business use purposes only. You could have an exception under de minimis where you may not allow the employees you may allow the employees to drive it other than during the working day, but you would allow them to use it for personal use, to run errands, take it out to lunch, or to a doctor's appointment, things like that. But that type of personal use throughout a year would be de minimis. Qualified non-personal use vehicles, if you do have vehicles that the employer has equipment on those vehicles and they require the employees to take those vehicles home, you could qualify for an exception to picking up that personal use through the qualified non-personal use vehicle. And auto dealerships do have some exceptions under demonstrator vehicle rules. So if I don't qualify for an exemption on that taxable benefit, or on non-personal use, then I would have to calculate what is the taxable portion for the personal use of a vehicle. So you as the employer have some options here as to how to figure out what that taxable use is. Under a general method, you as the employer are setting the standards. If you choose not to use a general method, there are 3 safe harbor methods that you could take advantage of. There's the commuting method, cents per mile method, or the annual lease value method. Under the commuting method, again, this is probably the simplest of the approaches that are out there. The commuting method is $1.50 per one-way commute, so round trip would be $3 per day. But in order to take advantage of this, you as the employer have to have a written policy that prohibits personal use other than commuting, and the employee using the vehicle is not a control employee. So the control employees would typically be the executive team. So you have to be careful there. Again, for commuting, you have a written policy that prohibits personal use other than commuting. And the individuals that are commuting in the vehicle are not your control employees. If you can't use commuting, the next method available to you is cents per mile. This is using the IRS mileage rate, which in 2024 was 70 cents, or excuse me, 2025 was 70 cents a mile. So you're going to use the 70 cents a mile to value the personal use in 2025. The requirements for this method is that the vehicle is typically driven at least 10,000 miles a year. The fair market value of the vehicle cannot exceed $61,200. And you would adjust the cents per mile rate if you, the employer, is not providing fuel for the vehicle. If you can't use either of those two methods, the default method is the lease value method, where you're going to use the IRS lease value table and the value of the vehicle to look up what that personal use amount is on an annual basis. So that we do have the annual lease value table for you in the booklet. Keep in mind with employer provided vehicles, there are record keeping requirements. You as the employee must keep record of what those miles are, either through a daily log or some representative sample or pattern of use throughout the year. That sample period, if you're going to use that, would be looking at least 3 months of employee use to derive that. If you believe the data is unreliable, you can treat 100% of the value of the vehicle as personal use. We do have, to help employers that, or companies that have vehicles they provide to their employees, we do have data collection forms in the materials, and I believe that starts on page 135 in the materials. So again, we would encourage you to copy these pages right out of the material, hand them out to your employees that are using the vehicles. So the data collection form will get all of the information you would need to use any of the 3 methods that we've been talking about. So you're going to get the number of commuting round trips, if that's what your plan is. You're going to get a breakdown of personal use and business use based on miles. It also has a box for who's paying for the fuel, if the employer is paying for it. And it's also looking to see if there's a control employee involved as well. So with this first page, the employee is going to complete it and turn it in based on the logs they're maintaining. From that information, you can then use that to, on the next couple of pages, determine which method's going to work for you, and completing those worksheets gives you the personal use amount for you to pick up on an employee's W-2. So again, it's important to be getting this information completed in a timely manner so you could get them into the W-2. The IRS does, especially in the area of employer-provided vehicles, there is a special accounting rule that allows you to put the reporting for vehicles on a fiscal year rather than a calendar year. So you can put them on a 12-month period where you can exclude up to 2 months from the calendar year to give you time to collect this data. So that the 12-month period would be a fiscal period beginning November 1, ending October 31, or you could select a 1-month deferral, which would put that reporting period at 12/1 to November 30, just for purposes of getting the personal use information that you need and giving you enough time to get these numbers into payroll. You do have another polling question. Under the commuting method, what is the taxable value per one-way commute? So you see you have 4 options there. Okay, the answer to that, if you were listening earlier, is $1.50 per one-way, $3 is round trip. So if you answered C, that is the round trip one-day rate, not the one-way rate. So let's talk about our S Corp 2% shareholder employees. So if you are an S corporation that employs shareholders and they own 2% or more of the stock, you have taxable fringe benefits for those individuals. And that fringe benefit is taxable in its entirety. There's no exceptions for the first 50,000 in group term life. For your accident and health, your life insurance, it's going to the actual amount of the premium being paid. Same for disability and workers' comp. You're picking up the actual amount of the benefit the employer is paying for those benefits, and that is taxable as compensation. So you need to be aware of that if you are an S corporation, that you're getting information for those fringe benefits. We do have in the materials on 41 and 42 sort of a list of common fringe benefits that are out there. There could be even though that fringe benefit is taxable for federal purposes, it may be tax-free for state purposes. So take a look at the table we provided there for you, and make sure you're taxing them in for the appropriate taxing authorities in the right way. There is also in your materials, we talk about a gross up, and as you're coming up on year end and you're including these fringe benefits in an individual's pay, if you're putting it in without a gross up, it's going to take various tax amounts from the employee's normal take-home pay in the period that you're going to include it. A lot of times these fringe benefits are subject to Social Security withholding, subject to federal income tax withholding, state and local as well. So you do have an option if you're trying to keep the net take-home pay the same in the period that you're including the fringe benefit. You can gross them up by taking the amount of the fringe benefit, the amount you paid for that taxable fringe benefit, dividing it by a formula, of 100% minus the sum of all of the tax withholding percentages, and then you gross that benefit up. What this does is it takes the amount of the fringe benefit and it increases it. And you would be including the higher amount in a gross up into the pay for that period. And then when the various taxes come out, the net amount left is the actual amount of the fringe benefit that you paid. So in the example that I have on the slide here is for Pennsylvania. So once the benefit was $2,500, when we take out all of the withholding amounts, it grosses up to $3,775. So the employer in this example is going to pay an additional $1,275 for that fringe benefit. So be careful when you're using this type of approach, because the employer is paying more than the actual amount for the fringe benefit by grossing it up. As you're coming up on year end, best practices is that you want to be determining your taxable fringe benefits by December 15. If you're going to use a gross up, you have to calculate what that gross up amount is. You have to deposit your payroll taxes in accordance with the deposit requirements. So in the period you're including them, you have to be depositing the related payroll taxes. You have to update your records. If you're using outside service providers, you have to notify them what those fringe benefit amounts are. And you have to reconcile with W-2s and 941s. So you do need to make sure you're taking care of these items in a timely manner. So December 15th will be here before you know it. We have for you a comprehensive example to sort of show you how all of this comes together. So on page 47 is the comprehensive example. So what we have here is our employee normally gets $6,923 on a normal biweekly pay period. We're coming up on the end of the year, and we're now going to include two taxable fringe benefits, one for personal use of an automobile, the second one for the group term life insurance in excess of $50,000. So in our example, that amount is $2,950. We do show you the employer provided health insurance here. There are rules for employers with 250 or more employees to provide this information on the W-2. So we wanted to include that in the example. Typically, the amount of the individual's take-home pay is $4,617 in a normal biweekly period. Once we're including those fringe benefits, if we're not grossing them up, that net take-home amount is going to be lower. And in our example, it's $4,027. So you could see by taking out the various taxes that the benefits are subject to, it reduces the net take-home pay. For 2025, not a whole lot changing on the W-2 from 2024. Best practices, keep in mind, if you are an employer with a 401k or a retirement plan, make sure you're checking the box in line 13. Box 12 has a number of required disclosures. There would be the value of employer provided health insurance is a DD code, 401k deferral, employee deferral is code D, and group term life insurance code C. Another item in terms of best practices, in our example here, we have a Pennsylvania employee. So typically Pennsylvania taxable wage is equal to the Medicare taxable wage minus the group term life insurance pickup. So a good way to go through and check the math and make sure you're in compliance with that is looking, comparing those numbers. In addition to the group term life, the auto fringe benefit is also tax-free. So $2,950 in our example is non-taxable for Pennsylvania purposes. So if you would subtract that from box 5, you get the $180,000 in box 16 and box 18. So, again, keep those in mind as you're coming up on year end. Kayla, any questions from?
We have just one, which
Okay.
is, can you switch from the lease value method to the cents per mile method?
Okay, so the question that came in is, can you switch from the lease value method to the cents per mile method? So a couple of things here. When you are using the lease value method, you as the employer are required to use that for 4 years before you can make a change. So part one is if you're using lease value, 4 years. After 4 years, you can convert to any of the other methods that are there. You could use cents per mile, or you can revalue the vehicle and continue to use the lease value table by changing it to a lower fair market value, but you would have to use that for another 4 years. One of the things too, when you're looking at annual lease value versus cents per mile, in your materials, probably on page 39, we do give you an example of what is the employer pickup under the annual lease value table. So even though under the annual lease value, it's a 4-year value that you're using, what you may find is that the value for personal use of an auto under the lease value table may be less than the value you would get on the cents per mile, because cents per mile keeps going up. In 25, it's 70 cents. If you are to look at the two examples we give you on page 37 and 39, we're dealing with a 5,000 personal use miles. Under the cents per mile, that is going to be 3,500. If I adjust it, because I don't provide fuel, I can reduce it 5.5 cents. That's 3,225. If I'm using the lease value table for a vehicle that's 25,000, that same 5,000 miles would be valued at $1,712.50. So even though the annual lease value has that 4-year commitment, you may find the value under that approach, based on the fair market value of the vehicle, is going to give you a lower personal use pickup than the cents per mile. So hopefully I didn't muddy the waters too much there. But if you're using annual lease value table, you must use it for 4 years before you can switch over to a cents per mile for that individual.
Thank you, everyone, for joining me today. We are going to walk through how automation and AI can help reshape your small business accounting departments or teams. Over the next around 30 minutes, I'm going to go show you practical examples of where automation can make your work faster, more accurate, and less stressful. First off, automation is not about replacing people. Automation is about focusing our energy on what makes your businesses move. Here's our agenda here. We're basically just going to go through building our AI system. So what we'll start with here is the first piece of this, of why you should automate your accounting system, or why you can automate your accounting system. My hope is by the end of this session, you will know what tools to start with, how to roll them out effectively, and then what kind of results to expect. So let's start off with the why. We'll get back to why automation matters more than ever right now. Many of the small teams or small accounting departments spend between 40% to 70% of their time with either manual data entry, repetitive reconciliations, or double checking spreadsheets. This could actually be valuable time that could be used for analyzing results and planning for growth. Automation also shortens the close cycles, which we'll go over. It does this from weeks to days. Imagine closing your month end by the 5th day of the following month instead of the 15th. And on top of that, you have fewer errors. You get your information faster access, and you're able to provide more clarity and confidence about your business. A couple things to note here. This is not about a shift for technology's sake. It's about better visibility and better decisions. So now that we talked about the why, let's go into the principles of what makes automation truly work. So before adding any new tools, you want to start with structure. You want to standardize first, automate second, define the what's, the when's, the how's, create naming conventions. We're going to go over each of these today. Coding rules. Sounds scarier than what it is. It's not computer coding, but we'll go over that. And then clear standard operating procedures. Once things are standardized, automation just begins to flow naturally. This makes it much easier to run your departments due to the fact that you have that standardized automation that's flowing naturally. Next, you also want to pilot a workflow. Your workflows are things like accounts payable, accounts receivable. You don't want to automate everything all at once. What you want to do is pick high impact accounts. So that's your accounts payable, accounts receivable, expense management. You want to measure the results before and after. You also want to document and train your team and make sure they're using the systems properly. One thing you want to remember is automation just magnifies what already exists. So if you have messy processes, automation is going to make those messy processes just run faster. So with that in mind, let's take a look at where most teams start, and that's with accounts payable, but we have a polling question first. The question is, which of these is a reason to automate your accounting department or activities? And the answer is A, fewer errors. Back over to the slide. So the accounts payable process, this is going to be the biggest opportunity for time savings. There's tools like QuickBooks Online Receipt Capture, which uses optical character recognition, OCR, for short, and you're going to see me saying that a lot. And what this does is it automatically reads things like your invoices, uses AI to suggest codings. Just a couple things to note of these types of applications. They're all cloud-based. Most of them are cloud-based platforms that help businesses and accountants manage financial documents like receipts, invoices. Again, it uses AI to extract data and automates tasks like expense management. And it saves time by reducing the manual data entry. Additionally, each of these types of platforms use data extraction tools to help businesses and accountants organize their processes and organize documents, bills, receipts, bank statements. Optical character recognition will extract information from documents, and on top of that, these systems also retain the supporting document as well and keep it in a stored secure area that can be easily searchable. And we're going to go over each of these piece by piece as we continue through the rest of the discussion. On top of this, these applications will also fetch documents. So they'll fetch things like bank statements. And then they could take those documents and integrate it right into the accounting softwares. It happens with QuickBooks Online, where you can add your bank reconciliation directly, your bank statement directly to your bank reconciliation. This just simplifies the entire bookkeeping process. Next, instead of typing data in line by line, what happens is your bills will come into a central mailbox, such as whatever your company name, your accounts payable at yourcompany.com. It will use that OCR to pick up the text, and then AI to look at historical information to see how it's coded and to automatically code that. And it will also then, on top of this, it can also batch multiple expenses together. So that way you don't have to go and approve multiple invoices or multiple expenses at once. And how it does this is by setting out an approval email or contact to the various individuals that need to approve the invoices, and then they can go and easily either approve or disapprove. You can also add thresholds, which we'll talk about as well. Through systems like Bill.com, which is what we use, and Mello, that's another type of platform. You can schedule payments by due date. You can also pay stuff by ACH, even paper check as well. Bill.com, which I'm going to refer to a lot because we tend to use that one because it really does well with integration. Bill.com is also a cloud-based platform as well. It helps with automate. It's a software platform that automates and manages the back office tasks for small to medium businesses, and it will do that with accounts payable, accounts receivable, and the bill payment. It simplifies the processes of invoicing, which I briefly was talking about, expense tracking, vendor payments, and allows for businesses to pay faster and save time with manual tasks by automating the workflows such as payroll, accounts payable, accounts receivable, and then integrating Bill.com into your accounting software, such as QuickBooks is an easy integration with accounting software. These applications also have online payment platforms that are designed to simplify the business-to-business payments by allowing companies to pay vendors via ACH or credit card or transfer or bank transfer, and then the vendor will receive those funds in a preferred method. They might have a preferred method of a paper check or some type of electronic deposit. This offers features really to help automate the payment and manage workflows. On top of this, it also syncs directly to the accounting software. Bill.com does it very well with QuickBooks Online. So continuing on here, with automation, you want to make sure you maintain strong internal controls. You always want to separate who prepares, who approves, and who pays. Two of these three must be different to have proper controls. On top of this, vendor management also matters. You want to make sure to keep Forms W-9 on file. Also verify banking details. I'll go over some of that later. You also want to use thresholds for approval. In Bill.com, you can set certain specific thresholds. So something, anything over 10,000 has to get some type of approval from the CFO or NCO or the executive director or the treasurer. On top of this, you also want to maintain a blocked vendor list and make sure this is updated every 6 to 12 months. So now with the goal with the bills flowing smoothly and getting paid smoothly, the next area or workflow would be accounts receivable, is what we want to take a look at next. So automation in accounts receivable will help you get paid faster and improve cash flows. QuickBooks, for example, allows you to schedule reoccurring invoices for things such as retainers. You can set them reminders to automatically remind you every 3 to 7 to 14 or 30 days. And then also have embedded payment links directly on the invoices prepared by the accounting software, where the customers can pay you either by ACH or some other means. On top of this, you can even pass along any type of fees as well. If you have any type of fees or policies, you can set it to do that as well. On the back end, there are things called bank rules and bank feeds, which we'll go into shortly here as well, which automatically match your deposits and your invoices. This will keep your accounts receivable clean and accurate. So just want to go do just a quick, little brief example of or case study of a client that we worked with. They actually reduced their days sales outstanding from 48 to 36 days by just doing two simple things that I just said. And the first one was scheduling those reminders to invoice, and then also having payment links added into their invoice. It was able to reduce the collection days in a pretty quick turnaround. So now let's talk about how to keep this data flowing smoothly with bank rules, bank fees and rules. So what a bank fee and a rule is the integration of the accounting software to the bank account. So having this done allows the accounting system to automatically clear things. You can create rules with this as well. For example, with coding, things like fuel, subscription, utilities have a consistent coding being used for a particular type of expense. Also, you can do this with also your top vendors as well. Now there's going to be allocations, things like that, but this is just on a more standard basis. You want to use transaction memos as well in these in softwares. You could want to include things like the jobs. If you separate things by jobs or departments, this can help reports to become more insightful and can also provide better details as well. You also want to create a habit of, on a daily basis, to do a 5-minute daily reconciliation. This prevents month-end pileups and stress. It just makes the overall close process much easier. So once transactions are flowing automatically with accounts payable, accounts receivable, we can then focus on expense management next. So modern tools like Bill.com will give you real control over spending. These types of applications or platforms, they'll issue virtual credit cards, and you can do this even by department or by project. On these cards, you can have spending limits and even merchant restrictions as well. It also requires receipts to be captured instantly, which are done through mobile apps. On top of this, you can also set policies for things like meal limits or travel classes, and they're built right into the application. So then that way, this system will flag any type of exception automatically and then sync the data to the general ledger by the particular class or department. When employees know their structure and transparency, spending behaviors will improve dramatically, is what you'll notice when these systems are up and running. Note that these financial platforms, they provide corporate cards. It's a virtual card connected to your bank, and they provide expense management tools and accounting and automation for any type of business, small, medium, large businesses. Additionally, these systems are just to make the overall process easier. They use their technology, and the features are very easy to use. They're very user friendly. These types of systems continue to gain popularity amongst businesses of all sizes and types, with a comprehensive approach for tracking expenses, budgeting, financial reporting, and lastly, even applications that provide businesses with the ability to manage international payments with multiple currencies and account spending. So now let us take a look at the next workflow. This is actually going to be the payroll and time tracking. Depending on the number of employees that your businesses have, payroll can be the most repetitious of all the processes. Automation through platforms like Gusto and ADP, these simplify the time tracking. Time tracking is right into the application. It feeds the hours directly into payroll. Then the thresholds are used to then push out emails to then supervisors or department heads that can then go and review this time and then do a click for approval. Then they could keep the process going to out to payment. So just a couple notes with ADP and Gusto. These are all-in-one global human resources platforms that help companies manage and pay employees and contractors. Each of these simplify they simplify the hiring process both nationally and internationally, and by their handling of payroll, benefits, taxes, and even compliance. So, and this compliance is even done even if the entity doesn't really even have a legal local level. These systems can handle it. So back to the slide. On top of this, we can use earning codes, and earning codes could be earning codes are just your general ledger codes, and they can be assigned by class or department to each employee. So then at the end of each pay period, you just get an entry that automatically gets uploaded into your accounting system, making the process even faster then. You can set reminders for reoccurring stipends. Also have the system remind you when you need forms like W-4 or even forms I-9 are about to expire. It will tell you that. It's programmed to do those things. I do recommend quarterly audits on any type of automation tool. This just confirms that it's accurate. Otherwise, it will continue to do the wrong thing if it's not set up correctly. Once payroll is efficient, the next thing we can look at is the month-end close process. The month-end close process is where you get to see all the reaps of all your benefits for automating these systems. You want to use a centralized checklist that assigns owners and deadlines. You can have tools then that automatically roll forward schedules, and they do this automatically in things like QuickBooks that roll forward your prepaids from one period to another, accruals, deferrals. You can also have reoccurring journal entries created in these systems that'll automatically post on a monthly basis any type of payroll allocations, maybe amortization, depreciation. It just automates those month-end required journal entries. On top of this, there's systems that will provide variance analysis. There are platforms that will flag unusual results on statements and prompt you for explanations on top of that. So they're just simple. QuickBooks Online has an online market that has applications that can really do anything, and that's one of them. They can take a look at your reports and provide a summary of the variances. This structure, what it does is it reduces last-minute surprises and shortens that close cycle significantly. Once your books are closed, the reporting this reporting just becomes much more easier and insightful. Automation is not complete without better reports. You have dashboards. When you go onto QuickBooks Online now, you have a dashboard that comes up and it'll show you performance indicators such as cash runaway, which is the amount of time that a company has to operate before it runs out of money based on its current cash reserves and monthly expenses. You can also have other things on there such as days sales outstanding, days payable outstanding, gross margin, labor percentage, really anything you can think of, you can program on these dashboards. And these are across all different types of softwares. Oracle NetSuite, one of the larger, more complex softwares, also has a key performance indicators dashboard that you can program and create the more useful performance indicators. You can schedule reports to be emailed to your management and your board automatically each month as well, and they'll push out those reports. Again, you can add notes directly into these financial reports to explain variances. You want to keep in mind that the goal is not more data, it's more clarity. That is your primary goal. I brought this up at the beginning. A lot of these automated systems will auto-file supporting documents. So things like Bill.com will automatically take that supporting document once it gets the whole way through the system, and it will put it into the general ledger detail. And in something like QuickBooks, you can easily just click on the transaction and it'll get you right to the supporting document. Some of the best naming paths I've seen, you don't have to follow these, but you want to use something consistent. I like to use year, month, vendor, description, and amount. That way it's easily searchable. These systems follow the IRS's document retention policy, which is typically 7 years, but you might have an internal policy that's different, and you can adjust it for an internal policy as well. Also, on top of this, everything that I talk about here, you want to make sure you have security. You need to make sure everything's secure. If it's not secure, then automation is very risky at that point. With typical electronics filing, secure documents is a must to properly maintain the system. QuickBooks actually does it automatically with their servers, but other softwares, if they're on your server, you need to make sure that you have that covered. And again, in the softwares that allow you to integrate with things like Bill.com or your bank, those supporting documents will get attached right to the transaction, the general ledger. And this will speed up your time if you have audits that you have to prepare for at year end. So now let's connect everything together with the no-code automation platforms like Bill.com, which I was talking about. What Bill.com, and we have other ones as well, we don't use as much as Bill.com just because of the simplicity, but these no-code automation platforms are the glue between two systems. For example, so a vendor will email you, it'll go to your Bill.com email box at your company's accounts payable .com. It will use the optical character recognition, the software, to extract the data, and then we'll push it to who it needs to for approval. Then it'll get paid, and then it'll go into QuickBooks. Again, these applications provide businesses with automation tools that connect different repetitive tasks, eliminating the need for manual effort and coding. These work by creating automated workflows like accounts payable, accounts receivable, that have a trigger. A trigger is an event in one application that affects one or more other applications or tasks that happen in another. These tools can integrate with thousands of applications as well. And you can perform things like even sending emails automatically, updating your customer relationship management systems, even posting on social media as well. An example of where these softwares are excel is, for example, when a customer deal closes in your customer relationship management system, your then accounting system will automatically get a invoice created automatically to go to the next step. Again, these are event-driven triggers that eliminate the need for rekeying data, reducing human error. So the next thing we'll look at here is how AI can be your co-pilot for your daily work. And again, you want to make sure you're working with AI that is secure. That's what you want to make sure you're doing. Our artificial intelligence, we hear it every day. It's transforming small business accounting. AI tools can draft things like collection notes, summarize monthly variances, even create first drafts of standard operating procedures. It can categorize ambiguous transactions from learning from your historical data and explain reasoning as well for that. Just remember, this supports you. It does not replace you. It allows you to focus your time in other areas like growth of the organization. And with any automation, again, you want strong controls and compliance to keep everything secure. Automation without security is a risk. You want to make sure single sign-on and multi-factor authentication is on for all of your financial systems. You want to assign least privilege access to individuals who should only see what he or she would need to see. You want to review this access quarterly for vendor changes, require callbacks for vendor changes, especially verifying banking updates, require callbacks for that. You want to lock accounting periods once they're closed. That way, the only way things could be changed is by adjusting journal entries, maintain an exportable audit log as well. QuickBooks has an audit trail function is built, report built right into it. Now let's discuss how we can roll this an automated system out on a step-by-step basis. But we have a polling question first. In relation to accounting system automation, which of the following is a way AI can assist? And the answer is D, summarize variance drivers for monthly reporting. All right, so then back to the slides. So our roadmap to set up an automated accounting system. So in the first 30 days, you want to document your current processes and roles, turn on those bank feeds, so integrate the bank account with the bank accounts with your accounting system. Pilot accounts payable. That's technically the easiest one to automate. The next 30 days, so 30 to 60 days, you want to implement approved workflows, and then start using the virtual expense cards. The hope is by day 90, you can automate your close checklist, create reoccurring entries, and then set up your key performance indicator dashboards. You think of each of these phases as building momentum on the next. Each strengthens the next, and each makes the system run to its full potential. So next, let's take a look at return on investment and common pitfalls of these types of systems. So return on investment, ROI, we want to look at three things: time savings, error reduction, and cash impact. You want to measure hours before and after. You want to track things like late fees or amount of time it takes to rework, and then see how your cash flows improve. On average, what we see is a typical payback on these tools within 6 months on those core tools, so accounts payable, accounts receivable, payroll. However, you want to be aware of pitfalls, such as automation chaos, which is using too many tools or failing to train your team properly. You want to remember that automation requires ownership and discipline. Now, to bring this all home, let's take a deeper look into the example I was talking about earlier in the presentation with our brief case study. So we have a small professional organization that we worked with that took their accounts payable process that took 10 days per cycle. They also struggled with missing receipts. What they did is they had that bill.com centralized email box created. It used optical character recognition then to grab all that data. It implemented approvals and the virtual cards, and it took that 10 days and dropped it all the way down to 3 days. This organization, as we said, they improved their accounts receivable workflow by adopting those schedule reminders, and then there's payment links that were embedded right into the invoices, and their receipts then were 98% collected at the end of each month. Again, the days sales outstanding dropped from 48 to 36 days, and on top of this, close was done within 5 days. The month-end close. So real results in 90 days. So now let's wrap this up with practical next steps. What we want to do is training, as previously stated, is extremely important for any automation system. You want to have a one-page summary of procedures per workflow, so one for accounts payable, accounts receivable, so on. Perform quarterly refreshes. You want to prepare new hire onboard modules to streamline the training process. In addition, record 3-minute screen capture to walk through workflows. Makes it way easier to learn. Your next step is simple. What you want to do is you want to choose a workflow, accounts payable, accounts receivable, whatever. Pilot it, document it, measure it, improve it, turn on your bank feeds and rules, launch approvals, and start your key performance or develop your key performance indicator dashboard. Automation does not have to be complex. It just needs to be consistent and simple. Each improvement that you do frees up time for you to think, plan, and lead better. Thank you all for your time and attention. And if anybody has any questions.
We have some time. We have 3 quick questions if we can address them quickly. The first is, do you have a list of suggested no-code automation platforms?
Yeah. So a couple slides ago, there is a couple here. So we do have the ones that we work with more would be bill.com, Gusto, ADP. They just flow well with QuickBooks and other softwares that we utilize, but there are other ones as well. But the typical ones that we like to work with would be QuickBooks Online, bill.com, and then Gusto or ADP.
Okay. And then the next is an online version of QuickBooks needed to use AI and automation?
No, it does not. But QuickBooks Online does makes it more flexible. But you are able to use these applications, not all of them, but some of them with QuickBooks Desktop.
And then the last one is, does Brown Plus do a consultation on how this works and how you can help?
Yes, that is done through our outsourced accounting department. If anybody does have any inquiries or would like to discuss this further, they can reach out to myself or other team members on my team, and we'd be glad to have a conversation with you.
Okay, that's it.
Okay.
Where we were here.
Hi, I'm Sherry Cracium-Bolin. I'm a tax principal here at Brown Plus, and we're going to wrap up today's webinar with information returns, specifically 1099s. As you know, there's not a ton of changes here, but any person or entity engaged in any trade or business must report payments of $600 or more in 1 calendar year that's given to an unincorporated entity, partnership, for example, partnerships, LLCs, certain types, and self-employed individuals. They could also give those to any legal service entity, and that's regardless of whether or not that entity is incorporated. And then certain medical payments also regardless of incorporation. So, as you know, one of the exemptions for sending a 1099 miscellaneous or NEC would be if the recipient is incorporated. That would be one of the exemptions, but that does not apply for legal services or certain medical payments from like your insurance companies. Just one side note here, the $600 threshold has been in our world since my entire career. And in 2026, that will be increasing to $2,000. So we will see that coming in the future, but keep in mind that for 2025, it's still at that $600 threshold. And then we, of course, now have the 1099 NEC, which is specifically for non-employee compensation, and that would require a separate 1096 form to go with it to the IRS, separate from the 1099 miscellaneous forms. Another note here too, while we're talking about thresholds, the 1099K form is what you receive from your credit card companies or merchants that you receive for any transactions right now. If you remember, those thresholds had also lowered, but starting in 2026, again, that will be going back up to the $20,000 or 200 transaction threshold. So for those that were getting those from like eBay or PayPal for just, you know, a couple $100 worth of sales online, those thresholds are going back up, but again, not till 2026. And then just a reminder, because there is that 1099K, if you are making payments to your vendors for services by credit card, you do not include those payments in your payments of $600 or more on your 1099 NECs or 1099 miscellaneous forms. So keep that in mind as you're going through those transactions. Vendors paid with a credit card, you do not include those payments when you're performing your, preparing your information returns. We'll start here. I have the W-9, which is kind of the key form for getting ready to prepare 1099s. The last time that was updated was just last year in March of 2024. Keep in mind that the IRS does not update these forms on an annual basis, and sometimes they may go a good 10 years before they do. But in recent years, we had a few updates trying to iron out the whole LLC classifications, I would say, trying to make that a little easier because, you know, as a reminder, every year, the LLC is what we affectionately refer to as a check the box organization in the tax world, because an LLC for income tax purposes can be treated just about any way that they would like. So an LLC is by default with one owner called a disregarded entity. So you'll see that verbiage throughout the form here. So one owner, LLCs, disregarded entity, unless certain elections are made by the LLC. And if there's more than one owner in an LLC, is by default a partnership, again, unless there is some sort of election in place. So very common for an LLC to change the way it's treated, make something like an S election to be treated as an S corporation. You can also make an 8832 classification election and change your LLC to be treated as a C corporation. Very common to see an LLC change to an S corporation. I have probably a couple every single year that do that. So keep that in mind. If you have W-9s on file for an LLC that's treated like a partnership or is a disregarded entity, make sure that each year you get a new form from that LLC, because they very well could have made an election to be treated as something different. And you'll want to make sure that you have that on file, because remember, an S corporation or a C corporation, you will no longer be required to send them a 1099. As long as they remain a partnership or an individual sole proprietorship, then you will send them a 1099 if they meet the other thresholds. So just a little bit about the W-9 here, a little additional things. If you are an LLC, you would put the name of the owner if you're a disregarded LLC in line 1, and then in line 2 you would put the actual business name. So and then under box 3A is where it gets a little bit more information here, and they've really done a nice job of outlining this now, so I think it's much less confusing than it ever was before. And you'll check the box to see which type of LLC are you. You'll put a P in there if it's a partnership, an S if it's an S corporation, C a C corporation, and so on. And then for the tax identification number, there's sometimes some confusion on this. Again, they've made this a little bit more clear for your LLCs. If you're a disregarded entity, meaning that it's just one owner of the LLC, which it could be an individual or a partnership or an S corp corporation that owns that disregarded entity. If it's an individual owner and it's a disregarded LLC, then you can use either the owner's social security number, or if you do have an EIN for that business, for example, you have employees, you can choose to use your EIN as the tax identification number on your W-9. Some filing due dates for you. Form 1099 miscellaneous is due February 2nd this year, 2026. For your recipient forms, and if you file those on paper with the IRS, which we'll get to a little bit later, there's probably not too many of you doing that anymore. And then if you file electronically, those 1099 miscellaneous are due to the IRS by March 31st, 2026. Form 1099 NEC for non-employee compensation is due February 2nd, 2026 this year, regardless of whether or not you file those paper or e-file with the IRS. It's also the same due date to your recipients. There is a 30-day extension that can be requested in writing by using Form 8809, but this will only be granted in extraordinary circumstances or when there's a natural disaster, catastrophe, or something like that. There is no automatic extension like there is for a lot of other type of tax returns, not for your 1099s or W-2s. All other types of 1099s can still be filed with the IRS by March 2nd this year if you're paper filing, and March 31st if filing electronically. So real quick, the 1099 miscellaneous form, not much changed on these forms this year. Several years ago, they got rid of updating these every year and put the dates. So there's an open-ended box there for the calendar year you choose to file. The only box that changed really is they eliminated box 14, which is the excess golden parachute payments, which are now reported in box 3 of the 1099 NEC, because they're more of a compensation payment, so they move those. Just a couple of reminders on a couple of these boxes. Remember that box 1 is the rents that you pay. Reminder that you would not issue a 1099 miscellaneous for rents paid to a property manager. So that a lot of times some of our commercial properties are run by a property management company or a real estate agent. You would not give a 1099 to those people for rent that you paid. And then, however, the agent would then give a 1099 miscellaneous to the owner of the property instead, assuming they're not incorporated. And then they would give that to them. And just a reminder too, if you happen to be a property manager or real estate agent, those should be given at the gross rents amount to the owners of the property. I've seen a couple recently that were netted, but they should not be netted. You should be giving the 1099 with the gross rents paid, and then issuing a statement of any expenses or commissions and things like that that you withheld from those rents to the property owner. Box 3, sometimes I get questions, what type of things go in box 3 for other income. Typically, you might see something, wages paid for a deceased employee. Somebody passes away, this employee, you still owe them accrued vacation, some wages, that type of thing that's paid. If it's paid to the employee after fact, you can put it on their W-2 that year, but a lot of times it's paid out to the estate or a beneficiary of the estate. In that case, you would then use box 3 on the 1099. Prizes and awards that are given that are not considered part of somebody's compensation, that would be something that you would put in box 3. Damages for non-physical injuries and payments for compensation to H-2A ag workers without a valid taxpayer identification number. And in that case, you would also then need to back up withhold the federal income tax. Box 10, just a reminder, sometimes people get confused by this. Amounts paid to attorneys for settlement agreements or claims, the claimants that you pay the settlement fees to the attorney and not directly to the claimant. Those would go in box 10 for your attorney, and that would not include their legal services though. So when you're paying an attorney for legal services, those payments again go on 1099 NEC, non-employee compensation. I do just have the example here of the 1099 NEC form. And again, only thing that's changed here is you'll notice that box 3 is the excess golden parachute payments added to this form this year. And again, just a reminder that this form is due even if you're filing all these electronically to the IRS by February 2nd this year, has an earlier due date to the IRS than it does than the miscellaneous form. And this is just the example of the 8809, which is the application for extension of time to file that I mentioned, where you can potentially get a 30-day extension if you have some extraordinary circumstance. And you can see there the list of forms that applies to. It's more than just the 1099s, other items that are basically due at the same time, February 2nd, 2026. I'm gonna skip this for just a second. A reminder that the IRS has started to mandate e-filing when there's 10 or information returns needed or more. And again, that includes all aggregated forms that are filed. So for example, you have just 2 W-2s, 3 1099 NECs, and 5 1099 miscellaneouses. That adds up to 10 total forms in the aggregate. That's the information return. Then all of those forms would be required now by the IRS that you e-file those forms. It's been in place for a couple of years now, so most people are getting used to that. But just a reminder, there is a free portal for businesses called Iris. That's on the IRS website. It's free to register, free to use. You'll want to make sure that you review the requirements and document all of that before applying. We have detailed instructions. There's a new format with all the instructions in it located in your handout and your booklet. And then also included here, there is a TCC number that you need to have and apply for before you use the system. So just a reminder, if you do not have that, or you may have had something that expired, make sure you kind of check that out before we get into the thick of things in the filing season in January, so that you're ready to go. And just back up then one slide. There is this form 8508 that if there is some reason specifically that you feel that you would request a waiver from electronic filing of the information returns, this is the form you would file. There is an exception for if you think it's just too onerous for you to be able to do it. There's also a religious exemption. If you do not use electronic filing for religious purposes, you would need to file this form in order to request a waiver so that you are not penalized, because the penalties can be fairly steep. I don't know that I have all of those penalties here, but there are penalties for non-filing. There's also pretty steep penalties for not e-filing now as well, but these are the, a chart here show you the history a little bit of our late filing penalties or not filing at all. So, intentional disregard, if we do not file those 1099s because somebody didn't want them, or they didn't want to provide you their information. If they don't provide you your information, they refuse to do that, then you are required to do backup withholding on those payments and send that to the IRS. And then you have something in, some sort of relief then for these penalties. But if you just do not issue them, I mean, it can be up to $680 per return, and that includes, it's kind of doubled because it's for not filing with the IRS nor the payee statement being provided to the recipient. So this can be pretty steep, and the maxes are well over $1 million for those. So just keep those things in mind. It's not really worth it. And we have another polling question here, true or false? Starting with filing year 2024. Businesses must e-file information returns if filing 10 or more forms in total. True or false? And the answer is true. Hopefully you got that one. I'm trying to beat a dead horse on that one, right? Pennsylvania, 1099 reporting. So you must report non-employee compensation and payments under an oil and gas lease amounting to $600 or more on a Form 1099. And you would use the same copy of the federal 1099 miscellaneous or 1099 NEC. They do not have their own form. And you would also use the federal Form 1096 you would not be required to use the Form Federal 1096. If you are filing 10 or more 1099 forms, just like the IRS now, you must file with PA through MyPath electronically. The 2025 forms, again, are due to Pennsylvania by February 2nd, 2026. Reminder, this has been around for quite a number of years now, but Act 43 created a non-resident withholding requirement for certain payers of PA source income and rents paid to non-resident individuals. Withholdings required when paying that type of individual $5,000 annually to a non-resident. Withholdings are paid electronically through MyPath, and you would use the quarterly withholding return and annual reconciliations like you do for PA withholding from your employees. Now there is Rev 1832. There's a copy in your booklets on page 207, 208 that you can give to somebody who says that they aren't required to have withholding. This can be several different cases. They could actually be a PA resident, and they can use this to certify that they are a PA resident. It could be a trust that's also considered a PA resident or an estate. Or it could be someone who's not subject to PA income tax for another reason, such as they're a corporation, or they're a partnership or a multi-member LLC. And they could say, hey, my address says Pennsylvania, but I really am not subject to this because say maybe they're remote, they provide their services remotely to you and they don't meet the $100,000 threshold for them to have to file in Pennsylvania. So that then would mean that you would keep this Rev 1832 on file with that being their signature on it, and that would prevent you from being getting yourselves in trouble for not withholding the PA withholding from them. Maryland 1099 reporting Maryland participates in the federal combined reporting program, which means that Maryland is the IRS shares information with them. So you would only need to file your federal forms, 1099 miscellaneous or NEC, with Maryland if you have Maryland state withholding. Maryland does not have nearly the same threshold as PA. I don't know if I've ever seen it, to be honest. You don't see it very often, but there is a $50,000 threshold. So if you're paying a non-resident contractor $50,000 or more, you actually are supposed to withhold the Maryland withholding from them, but they have 30 days to provide you with a tax clearance certificate from Maryland. And so long as they can provide that to you, they request it from the comptroller, they give that to you, then you do not have to pay that in. You can give that back to them and not do any withholding again in the future for that person. I think you would need to get that each calendar year if you would reach that threshold. Again, we don't see it very often, but you would only submit those, and then you would have to have 25 or more of those where you'd be required to submit them electronically. Information return compliance issues, just real quickly, I was running out of time here. I do get questions every year a little bit about this, how do we determine if somebody is an independent contractor or an employee? The Department of Labor lists 6 different factors that they utilize for this. The IRS separately follows a 3-pronged test: behavioral control, financial control, and then the type of relationship that you have. Again, behavioral control refers to facts that show whether there is a direct control over how the worker does their work and performs their work, whether or not you have control over if they hire somebody to assist them, what types of tools that they use. Do you provide them the laptop and all their tools that they utilize, or do they have the ability to use the software, the laptop, the assistance, whatever that they want? Financial controls are things like how much investment does the worker have in their business and growing their business versus how much investment there is from you as the employer or the hiring unit entity. How do you pay them for their services? Is it more of a regular wage, hourly, or is it by project? By project, less control over that than might be an independent contractor versus an employee. And lastly, the type of relationship. If they have you have a written contract that might spell out whether or not the two of you believe that you are an employee-employer relationship or an independent contractor. The IRS is not required to go by that written contract. They'll look more or less at the actual facts and circumstances surrounding the type of relationship that they see. Some things that control that, there's a lot of detail on the IRS's website if you're interested in looking through them, but key to understand is these big 3 items is what they will look at. If you're unsure, even after you've gone through all the detail and you've documented, you can send a form SS8 to the IRS with all of those details and ask them to make the decision for you. You can do that, or the worker can do that. There is also mentioned here the voluntary classification settlement program, which is a program available if you do realize that you have an entire class of employees that really should have been treated as employees, but you were treating them as contractors. This is a voluntary program where you can say that you will change their classification the following year, and it'll give you some partial relief for the payroll taxes. Because if you do pay somebody as a contractor that is then determined to be an employee, you can be liable for paying the payroll taxes related to the compensation that you paid to them. Just a reminder that the backup withholding rate is 24%. So if you do have that requirement, somebody did not fill out your W-9, because do remember the W-9 is actually your vendor certifying that they are not subject to backup withholding. And then there's also, we mentioned the B notices, which are the notices that the IRS will send out if there's a matching issue on the 1099s. So you want to follow up on those when you get them. And then lastly, this is not something that we're going to go over in any detail either, but I just wanted to put it out there so you guys could see what it looks like. There's a copy in your book for you, but this year brand new is the 1099-DA for digital asset proceeds. So you won't be preparing these unless you're an investment broker, but you could be a recipient of one of these this year. So in the past, there's really never been any reporting requirement for the brokers when you use a digital asset, digital currency to purchase something that's considered a sale, because a digital currency is considered an intangible asset and it's not actually considered currency. So when you do use that to pay for something, that's a sale of a digital asset. And these are the new forms that we're all going to get to see this year, if you have that. I think I breezed right through that section.
I got one more question.
So I got a polling question for you yet. How are you feeling as we approach the 2025 year end? Well, more okay or a great, the higher one, not too many overwhelmed. But do we have any questions?
We do, we have 4. I know we're kind of past
No.
time.
Okay.
But will the 1099-K be issued through Cash App for service-based small businesses?
Cash App, I'm not sure. I can look that up to see, because there are some things that you might think like a Venmo is not a merchant. So like somebody who pays you through Venmo or you pay somebody through Venmo, that's not something that will send a 1099-K. I'm not sure about Cash App. It could be similar maybe to Venmo, I'm thinking, but I can double check that and let the person know.
Okay.
It's just not one I'm familiar with.
Can you explain how you know whether your vendor needs a 1099 miscellaneous versus a 1099 NEC?
Yes, so NECs are for non-employee compensation, typically when you're paying somebody for services rendered. So most people you're paying for services are going to get an NEC, that's non-employee compensation. If it is not services, so it's rents or miscellaneous, the other income, which is non-service type, like prizes, awards, things like that, it would, the compensation for someone who's deceased, that'd be kind of an exception. But most of the time, if you're paying them for services rendered, it's going to be non-employee compensation most of the time.
Next question. If you have a disregarded entity that is owned by another LLC, which EIN should be used on the W-9? The disregarded entity or the owner LLC?
That's a situation where it's a disregarded entity, so you actually have the choice. You'll want to put the owner LLC's name on line 1, and then the LLC that's disregarded, that business's name on line 2, and then you actually have the choice to use either the LLC that is the owner, their EIN, or the EIN number of the underlying disregarded entity. And I'll tell you, it won't really create a matching issue either, because we have to, when we do an LLC return, any single member LLCs that it owns that are disregarded entity, we have to kind of list them and their EIN numbers in the tax return. So either one should be fine.
Okay, and then the last question is, what is an example of a certain medical payment, regardless of incorporation, that would require a 1099?
It's normally insurance companies that issue those. And since somebody asked me about it, I will say, if you provide medical services and your insurance company that's issuing payments to you asked you to complete a W-9, please complete it so that they have your information, because it is like, especially like if you're a partnership and you get your 1099 and they will do backup withholding, and then you have to report that and try to get that to pass out to your partners, which is a little painful on the tax return. So that's an example.